You ready?
I'm ready.
All right, let's get it.
Hello, everyone, and welcome to the show. My name is Chris Alaimo.
And I'm Ben Gassaway. Together, we are the Amateur Investors.
This podcast is our open source journal of everything we learn about investing and wealth management.
We're here to explore the key concepts, market dynamics, and investing strategies that will assist you on the path toward financial independence and financial literacy. Our mission is to build us up from amateurs to experts.
All suggestions are our own, and we recommend that you do your own research before taking any investment advice. See you in this week's episode. We hope you enjoy it.
Hey everyone, welcome to another episode of the Amateur Investors. This week, Ben and I will be giving a breakdown of inflation, what it is, what we're seeing, where we're going with the future, and where things are headed, basically. So, Ben, if you want to take it from there.
Awesome. Yeah, let's get after it. So inflation takes a few different forms, and I guess a common definition really would be it's really the combined decrease in your purchasing power of a given currency over time. But it's also the simultaneous rise in prices. So correlation doesn't always tie to causality. So when you're observing inflation, it's important both to recognize sort of the inflationary nature of prices, but also to understand sort of the contextual nature of what your currency is when compared against other currencies, whether that be Bitcoin, other fiat currencies. And really, inflation is a quantitative estimate at which the rate in which the decline in your purchasing power is occurring. And it can be reflected in the increase in prices. It could be a basket of selected goods or services in the economy over a certain period of time. And the rise in the general level of prices often expressed as a percentage, but it can be expressed in sort of other measurements, means that a unit of a given currency is effectively buying less than it did in prior periods. You might have, hearing stories from parents or grandparents that, used to go to the movies and pay 5 cents for a movie, but now it's like $50 for a bag, like a bag of popcorn. That's inflation kind of happening in real time. So just to kind of level set what that looks like. You want to talk about a little bit about what the Federal Reserve is sort of measuring with inflation, maybe how they do it? You want to kick us off with that?
Yeah, definitely. So the Federal Reserve was formed in 1913, I believe. It was a meeting between a bunch of bankers, and basically, I'm drawing a blank who formed it, but basically he was trying to investigate them for fraud and basically trying to look in for sketchy things that banks were doing back then, and then end up basically forming a coalition with a bunch of bankers to basically monitor and control the money supply. So, it seems very sketchy in just how they were formed to start off that, oh, I'm looking into them for fraud or poor practices with screwing over consumers. And then all of a sudden, oh, now we control the money supply or the money spigot. So it definitely has a very sketchy past, to say the least, in how they started off. Ultimately, what the Federal Reserve does is they try and control the amount of money going into the economy. And there's kind of two ways that they really do that. One is by controlling interest rates. So they set the interest rate that all banks have to abide by for loaning money and stuff. So they can increase it if they think inflation is getting really bad, so it makes it more difficult to borrow money or more expensive to borrow money, or they can bring it down in the time of economic downturns. The other thing that they can do is, in theory, they can print money. So they can basically print money and they can inject it into the system in various ways, whether through federal loans, whether through giving money to banks to loan out to people, or whether, we're seeing kind of with the COVID pandemic this was kind of the first time really just giving people checks that they can use to buy goods and services. But like with anything, there's ups and downs to doing that. Obviously, when you're lowering interest rates, you're basically making it easier for banks you're making it easier for businesses more so to borrow large amounts of money. I know like a lot of the Fortune 500 companies were borrowing money at like near zero rates, meaning that I was looking at something like a Warren Buffett, like Berkshire Hathaway, they can borrow at rates of anywhere from 0.1 to 0.5 of the assets on their balance sheet. There's no way, nowhere that Ben and I can find loans like that unless it's from our parents or friends giving us at near zero rates that they don't expect to pay back. But basically, a lot of businesses. Go ahead.
Yeah, your first statement was actually correct when you said that it's cheaper for banks to borrow money, because that's really the lever that the
Yeah.
Fed has to pull is the overnight lending rates and the Fed funds rate. So that's the rate with which banks can lend to one another, and then everything else from there propagates. So that was 100% right,
Yeah.
and that has a huge impact for consumers and the overall economy as well.
Yeah, definitely. So like I was saying, like Fortune 500 companies like Tesla, like Google, like Apple, like Facebook, like Berkshire Hathaway, all these big conglomerates, they can borrow at near zero rates. So what they're doing is they're basically borrowing money against their business that in the event that if they default, they would owe basically stock options or a portion of their business to the bank or to whoever in the event of, defaulting. But when they're borrowing money, they're buying more assets that produce them more money or cash flow that they can then pay back those loans that they have. Basically, the middle and lower class are the kind of the ones that are screwed over. Like I said, like when I was buying my house this year, I was buying a house at 3%. But if Berkshire Hathaway were to come in and want to buy that same house, they could borrow against their assets at 0.1%, buy the house and buy it at much cheaper rates. It's kind of what you're seeing right now with BlackRock purchasing up single family homes. I know it's probably going to work its way up to the Supreme Court to see if this is like legal, if they're basically just buying all the homes, and basically they're going to become the the landowners of America, versus also probably large multinational corporations. And then we're going to become a nation of renters. This is not to scare people, but I just know with housing prices going through the roof, I do expect a correction probably in the near future, but that doesn't mean that if they don't stop, they're continuing to add demand by buying up homes left and right, that could really cause a bunch of issues. And then this is kind of going along those same sentiment. So every quarter, the Federal Reserve also publishes every quarter of since their existence, or maybe CPI was developed in the 70s or 80s, I forget. CPI is Consumer Price Index. So it's defined as basically it's the amount of inflation that they're seeing per quarter. And when they talk about that, they say, they're trying to target, is their goal, target 2% inflation. I think that's over the course of the year. So 2% inflation, what they're trying to see over the course of the year. This year and last year, we've kind of seen abnormal amounts, or more so this year, we've seen a lot higher inflation because of all the money printing. And basically, as things are opening back up, there's more demand of all these things that normally didn't have demand. So prices are having to go up and such. It's just something that a really interesting note that I make. Robert Reich, he is an economist, and he had a tweet very recently, last month, I thought was very interesting. So basically, you have the Federal Reserve saying that we're seeing, 2% inflation from 2009 and higher now through 2021, but yet the federal minimum wage has remained at $7.25. I know that can change by state to state, and a state can decide whether New York or New Jersey or California definitely have a higher cost of living, so they've increased their minimum wages in terms of like purchasing power for people in their area. But it's just very interesting to note that, the Fed, the Federal Reserve, is the one saying we're seeing 2% inflation, yet in terms of federal policy, we've only seen minimum wage stay at $7.25. So basically, they're blatantly telling everyone, your money is losing power by 2%, and yet from 2009 to 2021, you have the same amount of hourly rate that you're getting paid if you're working an hourly job. So basically, they're telling you you're getting poorer because you're not increasing the amount of wages. I mean, unless you pick up more hours or you do a second job, but basically you have to increase your skills or get a job that pays higher amounts. But if you stayed in the same minimum wage paying job, there's no way for you to really get ahead, at least in terms of asset price inflation and acquiring assets.
Yeah, there's definitely I want to dig into that a little bit more. There's definitely double speak in the Fed all the time about what they think is, quote, good for the economy. And I want to list just like what the Federal Reserve's overall goals are, and to contextualize what they purport to be achieving and trying to go after. So the goals of the Federal Reserve are to produce maximum employment across the economy, stable prices, and moderate long-term interest rates. So just right there, it sounds like funny money to me, that you are just pulling levers to achieve maximum employment, stable prices, and just steady interest rates. What that sounds like is we should allow the free and open markets to have price discovery. But what the Federal Reserve does is they sort of insert themselves into sort of capitalistic dealings and they print money into existence. So how can you have proper price discovery when the measurement device to achieve price discovery is changing all the time? And just to contextualize what happened with the CPI sort of this year. So the CPI in May of this year jumped 5% year over year, which was the highest increase since the summer of '08. And people always like to jump to '08, '09 as the Great Recession. And that inflation rate and what Chris just said about the minimum wage increasing, it's a fallacy to say that inflation is good for the economy. Good for the economy doesn't mean good for the people, right? Is you have folks who have basic necessities, basic bills and things to pay, and just overall just wanting to save. What is so wrong about just wanting to save? Inflation truly is the theft of your ability to buy things over time. And inflation, at the end of the day, at least how I've kind of intuited it is unnecessary. By inflating the money supply and increasing the money that's in existence, you no longer have the ability to properly allocate things towards value. The injection point of this money created goes to the banks and the folks who are going to allocate it or just simply produce unproductive means of exchanges, which is just bank dealings. We talk about this all the time. With Bitcoin, you have a scarce resource that now puts the fiscal responsibility into the hands of capital allocators, which includes us as people, where we have to decide where our money goes. And when the inflation is so high and it's not in lockstep with sort of the basic earnings of an individual in a given country, you get inflated away and you get left behind. And when they want 2%, 3% inflation, well, they better match minimum wage to that, but they won't. So it's an unfortunate sort of like conundrum where the Fed is trying to produce maximum employment, but they're not paying, workers are not being paid properly, and inflation is just hurting those folks in employment because they'll never be able to keep up. So it's just frustrating.
Yeah, and there's a quote that one of my best friends has said to me. He didn't say it, but it was a quote that was really funny. It was like the Federal Reserve, or basically the federal government, says you can't pay anyone like less than this amount, and then corporations say we're not going to pay anyone more than this amount, and that was basically a play on words with federal minimum wage. It's also really funny. So Ben and I were talking about how the Federal Reserve kind of just talks out of both sides of their mouth, and then they also kind of the whole thing is basically like a lie. I don't want to call them out like that, but like Consumer Price Index, for example, in the 90s, back when Clinton was in office, they were always changing it to hit their target of 2% inflation. So basically what the CPI is, it's a basket of goods, and you're taking the average price over a certain amount of time on those goods. Back in the 90s, they saw that steak was seeing larger than 2% inflation rate because there was just a demand for steak or meat or beef in the industry. So the Clinton administration, him and his financial staff, decided to replace beef or steak with chicken, because they said, oh, well, Americans don't really eat steak every night, so we're going to replace it with chicken because it's cheaper. So basically, they're always changing the basket of goods. And while I'm calling out Clinton here, Obama and George Bush, and also, I don't know, even now, but they're always finding ways to replace things. I know either during Bush's administration or Obama's, they replaced housing, so purchasing a house with were the mortgage rates with rental rates. So obviously, if you're paying rent, that's normally cheaper than the full cost of a mortgage. And then also they've replaced, for the longest time, they had an automobile. So they had a new purchase of an automobile, of an average 4-door sedan automobile. They now replaced it with a used, automobile. So now they replaced it with a new automobile, with a used automobile. So next they're going to be doing leasing. Like leases are going to be the next thing in the CPI. So they're always changing it, and they're changing their measuring stick. I know this is something that Ben and I have always brought up. Like, they're changing the ruler, and instead of measuring with a ruler, we're measuring with a yardstick, but we're still calling it like a ruler, or a foot ruler. So they're always trying to change the yardstick in order to achieve their goal of 2% inflation. Well, everyone else is like, yeah, but you keep changing this, but I want to buy a new car. They're like, oh, but don't worry, like, you're only seeing 2% inflation in used cars, which isn't even the case anymore. So I know leases are coming next, but they're always changing the terms and the definitions and like the rules for what CPI is. So it's a huge farce. I mean, lumber prices up 121%, gasoline up 49%, like all these different things that like the free and open market is screaming that like, hey, we're seeing a lot more than 2%. And then the next thing that they say out of their mouth is we're seeing transitory inflation.
Yeah, why don't we do a little bit of a relay here and go through while we kind of have the floor here, talk about maybe what the different measurements of inflation can be, and maybe we pick the one that we think is best. I think there's different value to each of these respective measurements, but I think we know that CPI is just, it's impossible to like compare over time because of what you just said. The variables are always changing, so you're not even just comparing apples to oranges. You're comparing like apples to like a wood board. It's like you just don't know what you're measuring. How can you compare what you don't know what exists in it? So yeah, it's frustrating.
And I know you've mentioned on a previous episode, Ben, that inflation is very personalized. Like there's a running joke that, you know, if you're living in your parents' basement and you don't like leave often and you just drink beer and pizza, like inflation for lumber, gasoline, electricity, food, all those different things is not going to affect you the same way if you're a homeowner, you have a family of four, you like all these different things where you have to commute to work and stuff. So inflation is very personal in a way. Like if you haven't bought a new car in 15 years, you don't care about the inflated prices of new cars. You know what like?
Yeah.
So it is very situational and it's person by person as well. Yeah, but let's definitely get into the different measures of inflation.
Yeah, I think it's a good segue for the PCEPI or PCE, which is the Personal Consumption Expenditure Price Index, and that's one measure of inflation which tracks the prices and goods and services purchased by consumers or even just one consumer in the economy. And of all the measures of consumer price inflation, this measurement includes usually the broadest set of goods and services. And I don't know how individualized this can be, but that's kind of what Chris was just talking about. Is I personally believe that the best way to measure inflation is on a very specific, discrete set of goods, services, and also individuals. I think just broadly stroking an experience for one group of people doesn't capture what the overall economy is doing based on the CPI measurement. There's another measurement that I think is a little bit closer to sort of getting an aggregated measurement. But if you want to get really, really specific and really get meaningful data, I think you need to just make the sample size a little bit smaller, because if you're talking about what Jeff Bezos is experiencing, like the inflation of like super yachts, like I'm just waiting for, you know, the Xbox One to get even a little bit cheaper. So we're talking about just like totally different spectrums of life. But I think the PCE measurement is a really good one. And we'll definitely have links in our show notes when we get to that.
Definitely.
Want to take the next one?
Yeah. So the next one was the CPI, like we said, and that's kind of just like the examines the weighted cost average of a basket price of consumers' goods and service, such as transportation, food, Medicare, and all these different parameters. Like I said, they're always kind of changing the items in the basket, at least the Federal Reserve is. So it's definitely kind of hinders like the truth or basically seeing what it is actually. I'd love to do a calculation. This is something that I've wanted to do. I just haven't had enough time to look at what the CPI was back when it started being tracked by the Federal Reserve and leaving it as the same basket of goods that they did back then. Obviously, I guess if they replace it with things that are no longer around, like the price of a typewriter or something like that versus the price of a computer, but definitely leaving all the historic ones of beef, of a car, of all these different things to see what the true inflation is of the original basket of goods and how bad it is compared to what they're replacing it to.
Yeah, I would be curious to see that. I would also like, I mean, this sounds like a data science project that maybe we can play around with, but I think it would be really interesting to see also sort of like a flagged, maybe like a heat map of the overall contributors to like the general inflation, like how much has everything increased?
Sectors,
so even for things that are no longer existent, like I think it would be nice to see like the composition of contribution from each of these components, and then you can kind of like work through the things that fade away, like typewriters. But it'd be fascinating to see for sure.
Definitely.
Why don't you take the next one too?
Yeah, so then the next one is the Producer Price Index. This program measures the average change over time in selling prices received by domestic producers from their output. So basically, it's I guess it's receiving goods into a company and then selling it out into the domestic market, basically. The prices include the PPI are from the first commercial transaction for many products and some services.
Yeah, I guess the way to think about PPI, I wonder if this is like the way to think about this. But would it be cost of goods sold essentially, where it's like
Yeah.
what are sort of the wholesale rates that producers are getting? So it's the seller side of inflation. So the next one, which is GDP deflator, I think this is, and this is relatively new to me, but I doing some of the research for this episode specifically, I think the GDP price deflator is a pretty good way to get an aggregate sense of inflation across an entire economy. And I'll kind of give you my reasons why. But the GDP price deflator, also known as the GDP deflator, or the implicit price deflator, as Google will say it, measures the change in prices for all the goods and services produced in an economy. And a major benefit of the GDP price deflator versus CPI specifically is it's much more comprehensive in terms of measuring inflation, just because it's not based on a fixed basket of goods or services. So what it's kind of doing is almost like a rolling average of everything that's produced in an economy, which is much more representative because like the economy is moving in real time. Like people are transacting, finding price discovery, new products are coming onto the market all the time. So for something like measuring inflation, like it really can't be just this fixed, very convenient, antiquated measurement, because that's not how the economy works. It's happening 24/7. There's just transactions happening at all times. And I think this one gets a little bit closer, depending on how strong, I guess, the aggregation of all goods and services really is calculated. But this gets you a little bit closer to a dynamic real-time measurement of inflation, because you're capturing sort of a rolling average of the economy. And this measures the change in prices for all the goods and services, like I said. And it basically, the benefit of this more than, well, in addition to what I just said, is that it helps economists compare the levels of real economic activity from one year to another. So as opposed to trying to just like find this cookie cutter approach to measuring inflation, you have a real kind of like, what does the economy look like? And you're not just saying the economy of typewriters and hogs, but you're talking about what does the current US economy look like to what it looked like last year. And it's just a dynamic measurement. So I think this is a good one to use.
Definitely. And I guess I was even thinking about what I said earlier in this same episode. You know, like I was saying, we really weren't seeing inflation in 2020, and actually thinking back, that's actually not true. We saw asset inflation in the stock market. We saw it in housing prices. I guess the traditional person on the street that doesn't invest or doesn't put money into things, you know, or doesn't invest basically because they were at, you know, the mercy of losing their job because of the pandemic and all these different things. They were kind of using more money to sustain their needs, whether it's, you know, paying off their bills of their house or rent or food or whatever it is. But we did see, you know, crazy inflation, not only in Bitcoin and stocks and bonds and all these different things. People were trying to purchase up like scarce assets, I guess, or, you know, just assets in general in terms of the stock market of stocks and equity. And now we're seeing the reversion, that it's unraveling. Things are opening back up, so now people are wanting to go out, buy new cars, you know, like they got their job back, you know, or the you know, that they're just, the economy's opening back up, so now we're seeing the prices flow from more of the equity side of things or investments into like vacations, items, materialistic things. Go ahead, Ben, you want to say something?
Yeah, I was just gonna go back to kind of, I did want to talk about like really what maybe the state of affairs is in inflation. I want to get your opinion, whether you agree with the Fed that inflation will be transitory or rather temporary, or if you believe it's going to persist. And I'll give you kind of a statement that was given by one of the Economist officials. He cautioned that the surging inflation really is kind of creating, I guess, really sort of a duality for the Fed, where they think that they will be able to tighten monetary policy, but it may be impossible. And the reason why this is kind of like purported is that the spiking prices will likely persist, and due to the demand soaring, basically what Chris just said is sort of pent up demand from the COVID quarantining, and resulting supply and labor bottlenecks that are accelerants for price increases. And you're seeing it even in used car prices, Uber prices, which is a different story, but you're seeing that there's just a total shortage of certain supplies. And the Fed is going to continue to insist that these effects are transitory, but people believe that the central bank isn't going to be able to tighten monetary policy to slow down the overheated economic growth. And just to sort of give context of why this is believed is because comparing the stimulus and the fuel behind this growth, which growth is not always productive. The massive monetary and fiscal stimulus was more than triple what was given out in the 08-09 crisis. And following Biden's $1.9 trillion spending bill, we're at about $5 trillion. And after the infrastructure bill, we're going to be about $6 trillion. So at this point, I think we're just in uncharted territories in terms of just like money creation in a given economy. And to think that we have the levers to raise interest rates to slow it down, I think about this more as like monetary inertia, where you've just created so much fiscal stimulus and monetary stimulus that it needs to go somewhere. And just because interest rates are rising, it's either going to be, what is that? It is the Keynes's liquidity trap, where you think that you can control the rates just by slowing it down, but you have sort of this compounding effect where folks have so much money, but it ends up just being hoarded in savings accounts because there's nowhere else to put it. So I just think it may unwind in a horrible way against what the Fed wants, in my opinion.
Yeah, exactly. It's kind of like Preston Pysh always talks about the spring being compressed and compressed and compressed until it finally releases. And then that's going to be, the money's going to start flowing or breaking, or it's got to go somewhere basically, or it becomes useless. There's so much of it. You're seeing hyperinflation. It's also very interesting. I know Ben and I were talking about the Federal Reserve reports quarterly, like CPI or inflation numbers. It's also funny when they're manipulating the basket of goods. If we see a recession, if all of a sudden prices start crashing because they raise interest rates, they can say, oh, see, it was transitory inflation. It's like, no, not really. Like, it's just we're seeing a correction in the market because you raised interest rates. Like, they can always they can always word it the way that they paint the picture that they want to show, basically. So it's very interesting. I know
the rules.
Yeah, exactly. And I know we had a tweet that we actually reached almost 500,000 people. I checked this morning, Ben. It was like 486,000 people looked at this tweet, which is crazy.
That's awesome.
I wish we said it, but I'll give the credit where credit is due. Michael Saylor said this. Everybody in economics thinks you need inflation, but there's not a single engineering discipline or single machine that was ever built that worked with inflation. I will say there was a lot of clever answers when people were replying to the tweet, and that part of the reason we got a lot of transactions. They're like, what about a hot air balloon, or what about tires? Which I get what they're saying, and it was clever. I'm like, okay, that was very, very clever response. But he's saying in terms of changing your ruler or your measuring stick is kind of what he's referring to as inflation, not inflation as in air into something.
Yeah, and I think even like that was it was a clever example for sure. Like I do like those funny responses, but I think it's not even taken out of context. I think it's just like not conceptualized what he really means by that. Like inflation is not necessarily just increasing the volume. He's talking about like truly the law of conservation of matter. And everything that we deal with across the entire universe, we are dealing with a finite amount of matter at the end of the day, right? Mm-hmm. And the universe is expanding, but it is expanding with whatever amount of atoms that exist. And the volume is increasing per se, but that's because space is whatever, infinite. I guess it's the only infinite thing. We have sort of created this illusion that economics doesn't have to abide by the law of conservation of matter. And I like to think about it as like the law of conservation of like monetary value. And the Fed is trying to override the laws of like fiscal physics and
thermodynamics and fiscal physics.
Yeah. How can you confidently say that you can just create money out of thin air and say that won't have unintended consequences? Because everything else that we're dealing with, we are on a world of, let's just take the scale smaller. It's the world. We're dealing with a world of finite resources, and we're trying to allocate infinite value. How do you do that properly? That's where you get unprofitable companies, unproductive sort of like civilizations, because people are just working away for something that they'll never be able to live off of. And I think that was a really great statement by Michael Saylor, because it's much more profound than, a plane doesn't expand. Like it's not about expansion. It's about creating out of nothing, which is spontaneous creation other than the Big Bang or whatever deity you believe in. it doesn't exist on Earth that in our power, at the very least.
Yeah, I'd love to use a quick example. So I know I was saying, you're changing the ruler. Let's just say I was telling Ben he's got to build my house, and I give him an inch, literally just like a little inch ruler. I'm like, okay, it's got to be these exact dimensions. And Ben's like, okay, yeah, it's going to take me a little bit of time, but I have an inch ruler. I'll measure out exactly how big I want Chris's house. But then the very next day I come and say, Ben, this is an inch, but it's an actual ruler, a foot ruler now. And it doesn't have any of the markings to say, 12 inches in that ruler. I say, this is the new inch. And Ben's like, oh, this looks a little bit different or bigger than it was yesterday. I'm like, no, but use this, okay, it's a little bit bigger, but kind of just guesstimate where that inch is. So Ben's like, okay, I don't really have markers on this ruler, but I'll guesstimate what an inch is. I think I know what it is. Then the very next day I come with a yardstick and I say, Ben, use this house and you're going to make an inch. But once again, there's no markings on it saying 36 inches in that yardstick. And Ben's like, okay, well, he changed the rule again. Let me guess. And you would build, Ben, I would assume, would build the best house that he can. But it gets even worse. Imagine I give him an inch ruler and then I say, okay, this is an inch. And then I say, I give him a foot and Ben's like, okay, I'm going to guess an inch. I'm like, no. This is a new inch. That foot is a new inch. And Ben's like, no, but it was much smaller yesterday. I'm like, no, you have to use that foot, that what now is a foot ruler as an inch. And Ben's like, well, that's going to change all the dimensions. I say, it doesn't matter. Just keep using that. And then the very next day I come with a yardstick. I'm going to get 2 or 3 very different houses versus with a fixed supply that you just guesstimate. And then with a fixed or not a changing supply of it's not even we're using an inch anymore. He's using a foot, he's using a yardstick, he's using a tape measure without any guesstimate of this is an inch. So you get very different products, and I can let you assume what the 3 houses would be like. The first one's probably gonna be the best. Second one, if Ben's a great engineer, checks his measurements a million times with the guesstimates that he made. And then the last one, your house is just kind of a pile of sticks. And that's just personally opinion of what I think would happen.
Yeah, I mean, I really like that example. I think that was a really good way to characterize it.
And that's what we're doing with the changing of the money supply. So that's how it relates to money or fiscal policy, basically.
Yeah, and I think I'm making a bit of an extrapolation, but I think when you have that level of variability in the measurement with which you can conduct sort of financial calculations and economic transactions, I think you also sacrifice quality at the end of the day.
Absolutely.
Because you have to make split-second decisions. And Chris and I were even talking about just doing a mining operation with our company. You can only get 48-hour procurement times, but that's the same thing with building a house. You only have a week where you can ask for quotes on doors and lumber because everything is changing so fast. And I think it's foolish to say that the $5 trillion that came into the economy are not accelerating that variability on prices.
Yeah, and I know that there was a basic business example. If the money supply is inflating, or you're seeing inflation, basically, there's kind of 3 things you can do as a business operator. There's one, you can do absolutely nothing, and you're then taking the hit on. So you would do nothing, because if you were to raise prices, your competitors could basically eat your lunch. And the best example is for a food restaurant. So they already work on razor thin margins. So it's very tough if you're going to start raising your money, unless you have an increase in quality, or you change how your business operates. Instead of being an Italian restaurant, we're now an Indian restaurant. So that tries to attract new customers because of the change in what you do. But so one is you do absolutely nothing, but then you're at the mercy of inflation. You're paying more for the bread, for the tomatoes, for the meat, for all the different products coming into your restaurant. So you're making even these razor thin margins are getting much, much tighter, or you're losing money. So that's option 1. Option 2 is you increase your prices. If you increase your prices and your other competitors decide we're going to just hang on for 6 months to a year, they could basically put you out of business because someone's like, oh, wow, the price of all their meals went up by 5, 10, 15, 20%. Why would I go there when I can go to a cheaper restaurant? Or number 3, which is probably the most common, is you start changing out the quality of the ingredients that you get. So for example, if you get tomatoes from a homegrown farmer or a local farmer, and it's really good quality, but then all of a sudden you've got this mega conglomerate that makes tomatoes that they sell them at razor thin margins. But if you're selling billions of tomatoes at razor thin margins, that's still a lot of money. Even if you're getting $1 per or a couple cents per, if you're selling billions or trillions of tomatoes, you can give a lower quality. So they start using pesticides, or they start using genetic genetic modification to get them to grow faster, but that doesn't necessarily mean that they're healthier or better for the people that are consuming them. So basically, normally option 3, they start replacing with cheaper goods and services. So then you're getting a meal at the same price, but it's with lower quality meats, or like instead of using filet mignon, you're using, you know, a tougher piece of meat or a worse piece of a worse piece of steak. And then so people are getting lower and lower quality goods. And that's exactly what Ben was mentioning earlier.
Yeah, thanks, Chris. And I firmly believe that that is the symptom of forced inflation over long periods of time, is you sacrifice quality, because producing infinite growth in a finite world only leads to a decay, or I guess the way that I'm going to think about it is a hollowing of quality. Because if you have sort of like the solid sphere, which is Earth, but we're trying to just infinitely grow things, everything becomes thinner, more hollow, and just weaker quality. I know this is kind of like poetic kind of speech, but you're trying to do more with the exact same amount that you had. So forcing growth when it's unwarranted or really unnecessary is a dangerous thing. And I think inflation over time is a very dangerous thing, and it's unnecessary.
And even gets dangerous with even large businesses. Take Apple, for example. Let's just say, for simple numbers' sake, they're a $2 trillion business. If you're seeing 2% inflation on a $2 trillion business, that's what? I did the math the other day. Hold on. Give me 1 second. There's so many zeros here.
There's too many zeros.
That's a billion. That's a trillion.
Is it 10 to the 9? The 2 billion.
Okay, so yeah, so for a $2 trillion company, Apple has to expand or grow their business by $40 billion per year. Over 1 year, in order for them to be beating inflation. Obviously, it can vary with compounding. You could see with people so they have to get $40 billion from this year. If we're seeing only if we're only seeing 2% inflation, they need to get $40 billion, which they can do. They can come out with a new iPhone, a new headphone, a car, a house, whatever they want. But then that new number is now $2.04 trillion, which is the 40 billion. And then if you keep doing that with the law of large numbers, you know, that growing is compounding exponentially. So then that 2% inflation gets larger and larger in terms of how much more money that they need to get in each year. And you get to a point, if you're seeing inflation of 10%, 15%, 20%, can Apple really expand their revenue by that much? And they're the best, supposedly the best company in the world on paper by looking at traditional fundamentals. So if they're the best company in the world and they're having to beat 2, 3, 4, 5, 10% inflation, what's that mean for a business that is basically what Ben was saying, like a zombie company, that they're burdened with debt they're never going to pay back, like not producing a service that there has a lot of demand. So it just gets, this snowball effect of bad debt, basically.
Yeah, I think this is a little bit like depressing I feel like we always talk about depressing things, but this is why we talk about Bitcoin as well, because that's hopeful. I think there is an out for this, and I think it really does come down to just how we peg the currency properly. I really am firmly bought into that, with Bitcoin being the denominator for economic transactions. It's just concerning to see like how the Fed intends to unwind this amount of spending, and how that economic inertia is going to kind of like plow through like a train. I don't know what it's going to look like, and it could be fine, but I don't see why it would be, because we're kind of playing games with just a lot of variables and a lot of people who are tied at this. So yeah, inflation I think is a dangerous thing. I think it's always described as sort of inevitable and good for the economy, but to me, I think it's a symptom of
an unhealthy economy.
An unhealthy economy, not necessarily a feature of a good economy, in my opinion. I think inflation is a symptom of misallocation and misplaced monetary policy, in my opinion. I think inflation at the end of the day isn't necessary. It just complicates economics, in my opinion.
Definitely. All right. Well, you want to wrap up? I guess we kind of talked about all the effects of inflation there.
I think we covered quite a bit. I think I would love to, maybe, Chris, we can work through a calculator on our website or something of that nature, like we did with our other 3 tools, about how to calculate your own personal inflation. And if I can get access to like a database of like a basket of goods and prices, maybe we can have folks select a basket of things and maybe their own income. We'll work through it, but inflation is a fascinating thing, and I'm definitely gonna be keeping my eye on it going forward.
Yeah, definitely. I'm thinking maybe even like the Farmer's Almanac for figuring out prices. I know they're normally pretty good with, meat and housing or whatever it is. Like kind of using an almanac to track pricing over time.
Yeah, I'll talk to my smart CS friends to see if we can do something in Python or something. But
definitely.
Yeah, no, Chris, this is a really good idea for an episode. And I think it's something I overlooked a little bit. I've been reading about it a lot with regard to the Fed, just characterizing this as transitory inflation. But more is to be seen with inflation breaking record levels of 5% CPI year over year. So we'll keep our eyes on it. But folks, thanks for watching, for listening. Like always, like and subscribe, write us reviews wherever you can. Our merchandise shop is currently live. So if you go to our website and go to the Amateur Investors Market, you can pick up sweet mugs like this at very reasonable prices. And it would just show a lot of love to the show. So we really appreciate you guys always supporting. Chris, I'll pass it off to you.
Yeah, pretty much that's it. Have a good one, guys.
Take care.
See ya.